Hey, g'day everybody, it's Tony Harrington. How you doing? Hey, look, I've got a video here for you. I just thought it's coming around to tax time. There's been a lot of stuff happening out in the markets. You know, in Australia, we've recently had an election where there was a bit of uncertainty about what was going to happen with negative gearing and capital gains tax and all this sort of stuff. So I thought now's a pretty good time just to touch base with everybody, give you a bit of a heads up, a bit of a reminder about what to do at tax time, how to make sure you maximise the benefits, okay? Because one of the big things about investing in property in Australia is really maximising your tax and your tax return. But then not only that, once you get your tax return, what do you do with it and how do you make your tax return work for you so you don't have to start working for money? So, you know, I remember, look, real early days when I was back working around the construction sites, a guy said to me one time, he says, go and see this accountant down here because he only charges $30, $40 to get your tax done. I thought, wow, $30? Pretty good deal, right? So we go in and it was like a production line, you know, just worker after worker after worker going through. And what used to happen was you get a tax return was around about, I don't know, $300, $400. If you got $500 back in the day, you were pretty stoked. And this is before I had property or whatnot, so it's just purely claiming, you know, against my taxable income. So anyway, then a friend of mine said to me one time, you know, and I had a couple of properties and stuff, and he said, oh, look, Tony, he said, go and see this accountant over here. He's a really good accountant. He'll probably do a lot better for you. And I said, oh, well, how much does he cost? And he said, well, $90. I said, $90 to get your tax done? I said, you kidding me? So anyway, he talked me around and I went and seen this tax accountant, and from the original one where I was paying $30 or $40 to the one where I went and paid $90, my tax return went from $500 to $4,500, right? Massive difference, couldn't get it. And then as I more into properties and more into investments and companies and structures and a whole range of things outside of that, eventually I've moved accountants and changed levels a few different times. But I think the moral of the story is, if you pay peanuts, you'll get monkeys, okay? So I'm not quite sure where you're at in your investment journey, where you're at from a taxation point of view, who your tax accountant is, but if you want to get in touch with us about, you know, who we can put you onto and show you a bit of stuff around how to really maximise your tax return, because no matter where you go or what you do, make sure you've got someone who really knows property, who understands property, and predominantly is a property investor themselves, okay? All right, so that's cool. So what we'll do, we'll just have a quick look at the board over here. There's about 5 things that you're going to need, okay, Rick, to make sure you get your tax return done. Well, obviously, number one, you'll need your group certificate, okay? So I'm pretty sure you would have had that, you know, by now, or if not, it should be around shortly. From your property manager, you need to get a copy of your rental statement, number 2, okay? So usually what they do is they send them out monthly, and then they'll just send you out a full 12-month statement. So you need a copy of that. You need a copy of your bank statement. So you need a 12-month bank statement that shows interest paid, all those sorts of things there and related to your bank statement. You need a copy of any receipts that you may have had during the year if there's been any costs or expenses or expenditure. And the final thing that you really need is your depreciation report. Now, hopefully if you're an investor through us, that you've all got your depreciation reports, and just remember you only need to do those reports once. You then take them to your accountant gets a copy of them, and your accountant starts depreciating on a sliding scale over the next, you know, 25 to 40 years, depending on fixtures, fittings, and that type of stuff. So get all that together, make sure that your accountant's got it all, and make sure your accountant maximises your claim and your investment. But here's the other thing that I want to quickly talk to you about. When you were set up originally, depending on who set your finance up and how you structured it, most of our clients, what we did was we sort of, your own home was over here, so whatever your debt was, let's say you had, I don't know, $250,000 debt on your own home, then there was an investment loan set up over here, so you would have probably put, you know, 20% down into that, and you would have borrowed 80% over here on the investment side of it, right? So what we were sort of teaching people and how we sort of moved now that I'm starting to do a lot more coaching and a lot more educating with all my clients is what I did probably back in the early days, unfortunately, but that's the way business goes, and that's the way I've just had to learn as I build it as I go. So what we're doing over here is that if your tax return all of a sudden went from, say, $5,000, and I've got clients who are picking up anywhere between $5,000, $10,000, $15,000 and $20,000, so let's say between $5,000 and $20,000, all of a sudden you've got a tax return that comes back. There's 2 things that I don't want you to do. Number one, don't go to Bali and don't blow it on a big holiday. Number two, don't go out and buy something crazy like a motorbike or a boat or, and just spend it and waste it. The idea was, okay, that when you invest, you pay less tax. When you pay less tax, you can pay down more debt. So the worst debt that you've got at the moment would be your home debt, because remember what we called it? Non-deductible debt, okay? Interest debt over here on your investment property is what we call deductible debt. So let's just use this example. If you got 15,000 back in this year's tax return, there's two things I think you should do. Number one, speak to your accountant and say, hey, listen, what's the best way for me to set up and move this money or structure this money, or can I load this money up over here and start paying this house debt down or whatever that may be? The second thing you should do is talk to your broker, because most of my brokers would have set up what was down here called a cash buffer. Okay, so there might have been 10,000 or 20,000 inside a cash buffer sitting on your investment loan. Okay, so let's presume you get 15 grand. Do you park a certain amount of money back on your investment loan inside your buffer account, so therefore that counteracts the interest, the costs and the expenses for the next 6, 9, 12 months going forward? Or do you pull a big portion of that and put it over here and start getting rid of this non-deductible debt? So if you put an extra 10,000 over here on your 250, you would now owe 240. So here's what it's doing. Two things. It's making you money, it's saving you money, you're paying less in interest, okay? So you're winning hands down. So the moral of the gig is to make sure that you maximise your tax return. Talk to your accountant, talk to your finance broker, okay? When you get that money back and it's parked, find the best way to sit it and use it. Is it, putting it against your interest? Is it putting against your home loan? And if you did this year in, year out for the next 5, 10, 15 years, and here's what the other thing was, hopefully now, you're starting to get some capital growth on your home. You're starting to get some capital growth on your property, depending on what you bought, where you bought, and your debt's starting to go down here. Now all of a sudden you're starting to leverage, and now you can start to look at, geez, can I pull more out? Can I go and buy another one? Can I repeat the same thing another once or two times, so to make sure that when I get to retirement, me and my family are going to be okay, all right? So look, I just thought I'd share that with you today. Hopefully it just gives you a bit of an eye-opener, a bit of an insight, a bit of a reminder about what to do with your tax and how to do it. And just remember one thing. The first 2 days that you're out working, predominantly that money goes in tax to the government. So make sure you get as much back and make sure that your accountants are really stepping up to the plate and making sure they're maximising your depreciation and the deductions that you can start to claim because you're now an investor, all right? The other thing, if you did want to have a talk about updating your accountant or working with us about, who can we put you onto or help you out, feel free to touch base. The other thing, if you want to look at your current loans, your current structures, have you got the right rates? Because there's a lot of changes going on in the banking industry right now. So let us know about that, because we can also organise for the brokers to get in touch with you and just maybe do a reset or maybe even do a restructure. And you always should be reviewing every 6 to 12 months. So we'll be talking to you a little bit more about that. There'll be a few videos coming out over the next, week or 2 weeks or whatnot. I want to really add some educational stuff to all my clients. So this is the type of thing that we'll be out there teaching. I hope that was helpful for you. Hope it sort of give you a bit of an understanding. Just remember, don't go blow it. Don't go to Bali. You hear it all the time. Don't go buy a motorbike, all right? Make sure you maximise your deductions and make sure you get the best out of it, okay? So listen, that's Tony. Happy investing. Feel free to touch base. Got my contact details. If you need anything, please let us know, and hopefully, you're going forward and you're going in the right direction. All right, have a great day, and I'll talk to you all soon.